Hi, everyone. Thank you for joining today's webinar on MSR management through market disruption. Looks like we've still got a couple people joining in, so we're just going to wait a couple more minutes and get started at 11:02. Thank you. All right, everybody, let's go ahead and get started. Looks like we've got a good consensus. So thank you for joining us for today's webinar on MSR management through market disruption. And David Burris, take it away.
Well, thank you very much. Welcome to our webinar today. We're very excited to have you as a guest. Certainly seems the new way that we do everything these days with a stay-at-home in place kind of order. So I think the only thing we're going to miss today is maybe some virtual popcorn or something like that. But I did want to introduce you to our two experts today that'll be giving our presentation. Phil Laren, over 30 years in the industry with capital markets and servicing experience, really experience in all aspects of servicing, modeling, trading, negotiating, hedging, risk analyst, and accounting analysis and operations. He's also the builder of our model, MSRlive. So he'll be doing part of the presentation. And then our other speaker today is Bill Berliner. He's our director of analytics, and he has extensive working knowledge of MBS trading, hedging, structural, and valuation operations. Has worked in the past for Thomas Reuters, Manhattan Capital, Countrywide, and others, and has co-authored over 20 different articles and chapters and books throughout the industry, and is a well-known expert. So with that, we look forward to really being able to address the issue of MSR management through disruption, and a couple of housekeeping items to talk about. First of all, questions will likely save till the end, but please feel free and chat those in to the chat line, and we'll look at those and address those toward the end of the presentation. And also, for all those interested, we'll be sending out a recording of this presentation out to everyone who attended. So hopefully those things will be helpful. And if in fact you want more of a private conversation discussion around your portfolio, then just note that in the chat, and then we'll certainly follow up accordingly. So with that, what we intend to cover today is, I know many of you have had to react to the market in such a way where the best decision you could make was to retain. And so now suddenly you're the proud owners of a portfolio 3 or 4 times larger than you ever imagined. And so we're here today to talk about the consequences of retaining. And then along with that is, what's going on with the forbearance activities and plans that are in place, and how does that affect servicers. And then the last part will be strategies for MSR management in terms of how to improve and perfect your position going forward. So with that introduction, I'll turn it over to Bill.
Thanks, David. Yes, so the thing that strikes me in looking at the markets these days is we talk about returning to normal, and some things are returning to, if not normal, to more normal levels and configurations, but some things are still off and are still kind of sorting themselves out, and there's no real consensus among market participants as to where things are supposed to be trading and how things are supposed to be trading. So as examples, like mortgage and MBS spreads are moving back towards, kind of their long-term levels, although they are wider than they've been. The current conditions also point out how difficult it is for us to actually come up with measures for some of these metrics that are consistent over time. But volatility is also coming back towards more normal levels in terms of both realized volatility in the say the Treasury market, day-to-day changes, as well as implied volatilities in the option market. And application activity, if not normal, is certainly rebounding, as we'll see. But what's not normal is the configuration of the coupon stacks. And by stacks, I'm talking Ginnie stack and the Fannie stack. And we'll go over that in a second. But that has implications for both the TBA market as well as the valuation of IOs and MSR values. So if you please flip the slide. Okay, so basically this is something I've shown, in the past. This is the current coupon, the Fannie Mae current coupon spread over interpolated 5-10 Treasury yields. And there's a couple things to note about this. First of all, the spreads have tightened a fair amount from their, obvious extremely wide levels that we saw in mid-March and early April, as well as the volatility, if you will, or the instability in this spread has diminished a great deal. Now, this is not certainly not a perfect measure. I'm using the current coupon spread, which was originally designed as kind of a form of interpolation between the coupons below and above par, or actually parity more accurately, taking into account the delay in MBS. But two things happened in April that kind of threw this off. One is that the market switched, and the major providers, mainly Bloomberg, switched from using Fannie 2.5s, because basically everyone knows there hasn't been much of a discount market for a long time. When things have traded at 102, that's about as low as some of the coupons ever got during when 2.5s were the lowest liquid coupon. But there was some liquidity came into play in April in 2s, and mid-month Bloomberg switched from using 2.5s as its coupon to 2s. But also the problem was that 2s only had one dealer initially providing prepayment speeds and projections for the Fannie 2 coupon. So then when a second dealer popped in and published much faster speeds, it really changed the metric a lot more than anybody anticipated. It tightened and it was reduced. It's basically the yield at that median speed or average speed, and it tightened it by like 18 basis points. So you can kind of see that in the data kind of towards the right, that one section where it tightens dramatically. That was kind of reflects both the fact that the market's tightening as well as that shift in the market condition in the way that index or that metric has been published. So something to keep in mind when you look at this, that it's not a great measure across time, but it'll give you a general sense of where spreads have been and where they're going. So if we can flip to the next slide. This is just the daily volatility of the 5 and 10 year treasuries using a 40-day look back. And you can see that we spiked it's a look back, so it's basically looking back 40 days from any point in time. So in the beginning of April, it was looking back through the really volatile periods that we saw in through March, which really didn't, where it was not uncommon to see say a 15 to 25 basis point move in the in Treasury yields. So you can kind of see that, and now that we've moved back towards more normal levels of volatility, and some of those really volatile days have dropped off from the sample, you can kind of see that we are moving back towards more normal levels. We're kind of at high normal at this point in time for the 10-year. The other thing that is interesting to note is that the levels we reached in early April were actually slightly higher than what we saw in late 2008 and 2009. I think we peaked out at like 12.3 basis points per day in April of this year. And in 2008, 2009, we were just slightly over 12 basis points a day. Something to keep in context. It was from that perspective, it was a very extraordinary period. But the next slide shows a different measure of volatility, which is the implied volatilities in the Treasury futures options market. Now, so this is showing now implied volatility is really just the output of an option model. If you use the actual price as an input into the model, it's rather than putting in volatility and the other metrics and kicking out a price, you use your price and it kicks you out of volatility. And that's an interesting way of kind of being able to compare option valuations over time, kind of the same way that people in the servicing market will talk, and IO markets will talk about multiples rather than absolute prices. It just gives a fairer basis of comparison. And you can kind of see that implied volatility spiked in early March, and it's been pretty high through the period through April, but has now trailed off and is moving back again towards more normal levels of about a 4% volatility. Now, this is also an imperfect measure because I can't control for things like moneyness and time to expiration. This is just the daily pricing of the 138 June 10-year note puts. But it does, again, give you an idea that volatility in the markets themselves, implied volatilities, have subsided. So we flip to the next slide. This is also kind of interesting. Purchase activity using the MBA's application survey plummeted in late March. I believe it was late March and early April were the lows. Actually, the low in this was the week ending April 10th, right around Easter. It is a seasonally adjusted index. So it takes account for the holidays and such. But we were actually given this week's report of a 281. We're more than 50% above our lows, and this also shows the 4-week moving average of it. There are a couple things going on. One is the financial conditions that weren't ideal for home purchase activity, and the very real reluctance of home sellers to allow people in their house that they don't know and that haven't been thoroughly disinfected. But it seems like the market's recovering to more normal levels again, where we're starting to see purchase activity seasonally adjusted to go back and rebound to to more normal levels, even though we are below what we were seeing at earlier this year. So now we've seen where conditions have kind of rebounded, and if not normal, you are certainly improved. The next slide will show you that not everything is not everything's returned to normal. This is actually a kind of a variation on a scatter chart of the Fannie 3.5/3 swap regressed versus the 10-year Treasury yield. You can see the trend line. This is for the last 90 trading sessions, and you can see that it went from being very high, well above the trend line, say at the beginning of March, or say mid-February, to now where it's below the trend line. And at one point, what's kind of astonishing is that this swap was slightly negative. Basically, people were willing to pay more for a Fannie 3 than they were for a 3.5. We saw that behavior in the Ginnie Mae market for a while. It's kind of reverted back to again being being slightly positive. But the thing about this tells you is that that's a very abnormal condition, and tells you that the market really, I would argue, really doesn't have a great consensus on where prepayments are supposed to be for these various coupons, as well as what's deliverable for the different coupons. And that's one of the reasons you're seeing this swap being so depressed. Right now, if the swap is at 10-30 seconds, that kind of equates to, for 100 basis points, which is kind of, as a multiple, that kind of equates to a 0.6 multiple, which is very low by historical standards. Now the flip side of that is the 4 3.5 swap is trading close to somewhere around 7/8 of a point, which implies a multiple of 2. And if you use that, and people in the industry have used those coupon swaps as a proxy or as a benchmark for where IO is supposed to trade, you can see that there's really no consensus as to where a 3.5 IO should trade versus a 4% IO should trade. And I think that there's really there are a lot of issues with where prepayments are going to go in this fairly high refi market that we're seeing with very low rates, as well as the different composition of what consists of the TBA deliverable cohort will evolve over time. So with that said, I'm going to pass it on to Phil Laren.
Hey, thank you, Bill. Thanks for that color. And the picture that Bill paints is that instability, and that's instability in all mortgage markets. Usually MSR, if things are unstable on the secondary markets, they're very unstable in MSR. So the cough in the MSR world is the COVID. In the MBS world is the COVID virus in the MSR world. So we're a lot more sensitive than what Bill was showing, and we certainly saw a whole bunch of volatility in all those charts and instability. The result of all that is that the aggregator price, when you were selling to a Wells or a Penny Mac, the implied MSR value was close to zero, and on the case of some Ginnie Maes, it was less than zero. So, in other words, if you sold to Fannie Mae at a price of 102, you could sell to the aggregator at a price of 101 3/4. So they were effectively, you were getting the MSR for free for certain loans in the period of March, April, May, and because of that, more originators were holding servicing, as David had alluded to at the start of this chat. Like as Bill was saying, with the market improving somewhat, the aggregator pricing is getting closer to normal. I heard rumors last week that they had an implied multiple of 3 and even 4 on the conventional product. Still not so strong on the government side. And for low FICOs, we're still not seeing any bid on the Ginnie side. And I wrote here, Fannie Mae bid about 80% of peak market. That was last week. I just saw it, one of our clients selling this morning, and the math through our models was still retaining about 2/3 of their Fannie products. So it's still a market to retain servicing. I will say, I contrast that. We can go to the next page. I contrast that with where the aggregator bid was relative to agency bids about a year ago, and our clients were retaining about maybe 1 out of 15, 1 out of 20 Fannie Mae loans. It was like between 5 and 8% were being retained, and today it's more like 60 to 70%. And when we calculate our retain release decisioning, we have a pretty sophisticated model that takes not into account not just what the economics are to retain versus release, but what are the tax consequences, what are the cash consequences, where, how long will it take if you retain to get the same cash you would have gotten on a release deal. So we have a pretty robust model that gives that advice to our clients. And again, a year ago they were keeping based on that 5 to 8%. Now it's well over half, and that's conventional. Government is even much more. The co-issue bid that we've been seeing, I've seen the bid between 1 and 2. Again, most of the co-issue buyers stepped out, and again, I'm speaking of conventional. The government co-issue bid has almost completely. I don't know of anybody buying co-issue right now from government. So if you were selling, those big buyers are out. I'm sure they're contemplating coming back in. But right now, the conventional bid. Now, I did get some recent co-issue rate sheets, and the most recent ones coming out in the last day or two. That bid multiple of 1 to 2, maybe it's 2 to 2 1/4. So it has, again, there's a little bit drift upward, but it's still well below where it had been. The co-issue bids were close around 4 about a year ago. And the bulk market, you really, there isn't a bid. The only sales we've seen are distress sales when people have to get move servicing for cash reasons, and so I think the market has taken advantage of that. And there's no bid on forbearance loans, and maybe you can get a 1 multiple if those are carved out. So it's again not a good time to be selling servicing, or either through aggregators or through the bulk and co-issue market. Can we go to next slide? And just to kind of illustrate that, we took our clients. These are our small to medium clients. So I pulled out the clients who are retaining 100% because they're big, large. We have some clients who are aggregators themselves, and so they're 100% in all markets retained. But for our small to mid-sized clients, they were retaining this back pre-COVID around 23%. So 1 out of 5 loans they would retain, 4 out of 5 they'd sell to an aggregator, and that doubled. That went from 20% to 40%. And that also keep in mind that maybe about half of our half to 2/3 of our small to medium-sized originators don't have the ability to sell Ginnies, and many of them also don't have their Fannie and Freddie tickets either. So they don't have a choice. So they would be at 100 pre-COVID selling released and 100 post-COVID. So really, if you take those guys out, it's more like 50% we're retaining, and now it's close to 100% in the post-COVID or current environment. Let's keep going. So getting to we've talked about how the bid is weak and why. I want to kind of hit a few high points as to why the aggregator bid is weak, why the co-issue bid is weak. The most obvious first answer is the coronavirus. The COVID viruses means, with more forbearance, you have much greater forbearance risk, and that means, you're not only not getting revenues, but you're also going to have to do some kind of workout with your borrower, and that whether you're servicing or sub-servicing, that's going to mean greater cost. And frankly, if the whole economy is slowing down, we could relate everything to coronavirus, but some of those people might be delinquent because they're, look, if you're a mortgage company and you just hired a few more people to handle your bigger lock, your higher lock volume, but then you find 3-4 months down the road maybe the volume slows down a bit, then you're going to lay those people off. That's not really a corona effect, and because the economy is pretty soft right now, we're in double-digit unemployment. We could have just exposure to traditional delinquencies that are maybe indirectly but not directly related to the virus. The other thing that happens to aggregator bids is whenever there's high volume, and we've had these historic low rates now for several months, and that means the vast majority of borrowers are eligible for refinancing. And when you get that kind of high volume of refi boom, as anybody on this phone who sells to these aggregators knows, it takes longer to close loans. They're backed up. Their underwriting, their processing can only handle so many loans a day, and so how does a typical aggregator handle that? They widen their margins. So they can't hire 10 new underwriters overnight, but they can widen their margins so the volume slows down a bit, and then keep just pay a little overtime for the existing underwriter. The other effect that was unique to the COVID that we don't see in refi booms is the back office operations that were outsourced to India, and that this is all the big banks, Wells, Chase, Citi, they all have huge presence out in India, and a lot of that is related to mortgage process. They're just kind of doing back office tasks. And when India shut down, they had to take it all onshore, and again, they weren't quite prepared for the kind of volume they were having. So again, further delays. How do you handle those delays? You either back off from the market, or you stop buying certain loans completely, or and the ones you're buying, you demand a higher return, and that means you pay a lower price, and that's why the retained value suddenly becomes better, because it's not the Fannie Mae price that's changing; it's the price that the aggregator pays to you. So that's also meant, and a further impact was that some of the bigger buyers, it's not. I talk about banks and their back office. Well, the big aggregators today are not just banks. It's not 2006 anymore, or 2012 even. It's in 2020 we've got some of the biggest buyers, the Mr. Coopers of the world, and the PennyMacs and AmeriHomes are not banks, and so they don't have a bunch of demand deposits that they can pull extra cash from. So they've got to they're finding these cash demands through the market rally, demanding margin calls from their broker dealers, to the servicing write-downs, reducing their financing, to all the other issues around this whole COVID mess. That's been a cash crunch for them too. And again, if they're running low on cash, one of the responses: buy less, fund less, and then or the ones you do fund, you fund at a higher margin. Let's go to the next page. So for all those reasons that we've talked about, both Bill and what I just outlined there's it's ended up that a lot of people who hadn't planned at the start of the year to hold servicing have ended up with a lot of servicing, and so the question is, what do I do with it? And the first is, if you're owning all the servicing, you've got to be ready for higher delinquencies because of the forbearance issues. We're having historically high delinquency rates that I think are going up, as we'll see in a couple of charts from now. It also, if you have higher delinquencies, typically your subservicer will charge you more for a 30-day and for a 60-day than for a current loan. And other fees, loss mitigation fees, forbearance fees, all of those are fees that you normally don't see. The actual, and I should say, there's some discussion among subservicers with respect to forbearance. I've had a number of discussions with a number of subservicers regarding this because, a loan in forbearance that hasn't made two payments is technically it's 60 days delinquent, although it's reported as current because you're not supposed to report those delinquencies. And a number of subservicers want to charge the 60-day cost. And I've had discussions with a number of subservicers, basically that it's not, normally on a 60-day loan, you're calling the borrower constantly. You're talking about, loss mitigation strategies, payment plans, examining their budgets. It's an intense amount of activity, and that is why they are justified in charging a higher cost for more delinquent loans. Makes perfect sense. In the forbearance world, there's some monitoring that's going on, but it's fairly minimal. It's maybe somewhere between a current loan and a 30-day loan. And it doesn't get worse as you go from 30 to 60 to 90 days. It only sort of becomes a cost for real when the forbearance period is over and you've got to come up with some kind of loss mitigation strategy. But so, I've had some discussions and some success in adjusting some of the subservicer costs to reflect that the forbearance is not the same as a typical delinquency. But you have to be prepared to deal with that and deal with your subservicer. The servicing fees themselves, of course, you're not getting that fee. You will get it at the when the forbearance period is over and there's some kind of reconciliation at that time. But in the meantime, if you have a 6-month or a 12-month forbearance, it means that servicing fee is coming way down the line in a year from now. So again, that's going to drain your cash. And then, advances, we've talked about P&I advances with Ginnie Mae, and the government's made a big deal of that and how they're, Ginnie Mae is even offering to step in with the P&I line, but very little talk about T&I advances. That is, you've got to pay taxes, you've got to pay insurance while the borrower's in forbearance if they have an escrow account with you. So it's that's not a trivial amount, as we'll go into that a little later. So you have to be on top of your cash. It's great to hold all the servicing, but you're not getting the cash you would have gotten from the aggregator, and you've got these potential advances that you ought to be on top of. And so, my advice is, it looks like you should retain, but retain carefully, be prepared, and we'll talk about some of the how you have to what steps you have to take in order to do that. Go to the next slide. This is what we're using in our model right now to project the delinquencies based off of the COVID crisis. And we took this delinquent, that gray line is showing a delinquency rate that's, as you can see, it's an all-in delinquency rate, and we've got it projecting to exceed over 20% in a few months' times, and then coming down over the course of really takes almost 2 years to come down. And you say, why are we having such a miserable looking delinquency path? Well, we made this projection based on we had data on Texas and Florida in 2017. Texas with the flood in Houston, and Florida with a couple of hurricanes both happened, within a couple of months of each other. So the data gathering was fairly recent, and it's a similar kind of in that little tiny sub piece of the United States. That is potentially how the whole United States may behave if you consider COVID a similar natural disaster. And frankly, COVID's kind of dragging on even longer, but at the same time, there are some mitigating features, and a lot of people who are suffering the most from COVID are not necessarily homeowners, so the impact may not be as great as we fear. On the other hand, the Texas, Florida homeowners, this is what we saw with them. So this is kind of, I'm hoping this is a worst case scenario, because what we're hearing now with the latest numbers that I've seen on the forbearance is that right now forbearance for conventional loans is somewhere between 5 and 10%. That's looking at a number of our different clients, and maybe 7 to 8% on average, and the government loans are somewhere around 10 to 12%, or 10 to 15%, with maybe 11% as the average. That being, and so there's a lot of, on the optimistic side, people are hoping, well, this is, if you were, if you were in need of forbearance, you would have already shown. You've had March, April, May, and coming up on June to reveal the need for forbearance. And if you haven't done it yet, then you're probably not going to do it, especially with the economy trying to get reopened again. I should say also, even the ones who have asked forbearance, in May, roughly 40% of those who were requesting made their May payment. Now, it could be they made the May payment and realized how bad things were, and then so they asked forbearance because they didn't think they'd be able to make the June payment, and the early returns is that the June payment might be a little less than that 40%, and so we might so that the delinquency rates may be rising, but every loan in forbearance doesn't necessarily mean a delinquency. So that's that's kind of the grim view. I have the grim view up here because I'm just that kind of guy. The more optimistic is that the country is reopening, and this forbearance, if it's 7, 8, 9% now, it's going to be less in the coming months, and so this COVID effect, using the Texas-Florida analogy, is too conservative. Frankly, Texas and Florida, they were only a week or two of hurricane and flood, and still the impact rippled through for over a year. So it's not something that necessarily is going to be erased. And I'm not sure, even with the economy's reopening, how soon are people going to be flying, and who's going to go to Disneyland if Mickey doesn't hug you anymore? So it's a question. It's still an open question as to how quickly and how broadly the recovery will be, if indeed we are in fact on the way to recovery. So we're using these numbers in our modeling now for our clients, and it's obviously having some significant impact on their value as well as their cash flow projections. We're going to stay on this, and as we see if the numbers improve, we would be thrilled to be able to adjust these charts down, and we're open to other wisdom and analysis to see for an alternative way to look at this advance risk. But this is the path we chose for now, and again we'll stay on it and keep you updated as time goes on. Let's go to the next slide. So I just wanted to show how impactful that kind of delinquency curve would be. I took a typical portfolio of one of the mix of clients that we have. It's about $500 million. Its value is around 75 basis points, about $3.5 million. It's a Ginnie Fannie mix, a little bit more Ginnies in Southeast and Midwest. It's about a year old. Average balance is it's about a typical Ginnie Midwest average balance. Let's go to the next slide. So that's as background. We with those numbers, we have our proprietary servicing model, which does projections not just of the value and the cash flows, but you can see those green delinquency numbers going up there because of the COVID crisis. And in this case, we take that curve and in some cases because of we do further FICO adjusters and other characteristics of these loans. These loans have a little bit lower than average FICO for a Ginnie portfolio, so that the delinquency goes even higher than those 20s. But it goes up to 30%, and hopefully that's we might be double and triple counting, and we're overly jeopardizing that portfolio. But it's not a crazy or outlandish expectation of a low FICO mostly Ginnie Mae portfolio. And I just highlighted the corporate advances, which are the advances related to foreclosures that a servicer has to make. And if you're using a sub-servicer, that will be part of their monthly billing. They'll send you a bill, say, well, we had to mow the lawn for this borrower or board up the house. It was abandoned and it's in foreclosure now. So and so that money you get when you file your claim, you get it back. But in the meantime, you have to advance it out of pocket, as well as the tax and insurance advances. And our model looks at every state and figures out what the average insurance is in those states, when the taxes are due, and so it goes up and down every month depending on what states are having payments due. So it's a fairly loan level precision analysis. But I highlighted the worst month there, where the worst month where it's about, if you add up your advances out of pocket, it's around $2.5 million. And remember, the value of the servicing was about around $4 million. So you're and this is a year into the process, so maybe it's worth about $3.5 million now. So you're talking about, let me put it this way. Supposing you went out and bought a bond for $100, and it was a great bond. It was paying 11% interest. But the bond guy said, "Oh, by the way, once you own this bond, and every couple of months or once a year or so, I'm going to call you up and ask you to lend me $80, and you have to get that $80 and lend it to him at some certain interest rate, and that's really what advances are when it gets this size. I mean, the size of the advances is 2/3 the size of your asset. So are you ready for that? Do you have lines of credit for that? So, and again, maybe I'm being Mr. Gloom and Doom, and hopefully the delinquencies won't hit into the 30% range, but it's something that you need to be ready for, and talking to your lenders, your warehouse lenders and your MSR lenders. Let's go to the next page. Just a bit on forbearance. There are GSEs and FHA/VA have loss mitigation waterfalls. Forbearance is one of the easy, in addition to the usual loan mod, rate and term mods, rolling balances into a new loan, all of that sort of normal servicing loss mitigation steps that a servicer will normally take. Let's go to the next page. There are extra forbearance plans, extra options available to a servicer with a loan under forbearance, and that Fannie and Freddie have a very simple and attractive plan where if the borrower, even if it's a whole 12 months of forbearance, at the end of that 12 months, you can just roll all of those accrued interest and taxes, insurance, put it to the end of the loan, file a claim, and Fannie or Freddie will pay the claim, and then so it'll be a new second mortgage, so to speak, that's in Fannie. It's due to Fannie Mae when the loan pays off, and so it's or matures or the borrower moves and pays it off that way. So it's fairly simple. The servicer gets their money back that they've been advancing over the last year, and it's kind of no harm, no foul. There's some operational challenges with it. For example, if you have to do this at the end of a forbearance period, one of the requirements of FHFA is that it gets recorded, in order for you to get reimbursed. It's a new mortgage, so it has to be recorded like any mortgage. And are the title, are the state recording offices even open? So there may actually be a operational challenge to getting those silent seconds done, but theoretically it should be a fairly simple process, and it'll keep the borrower with the same payment, so that they don't have to worry either. Next slide. On the government side, FHA has a similar plan, what they call a partial claim, where after the forbearance period is over, you can push everything to the end of the loan as a silent second, and then the servicer will be reimbursed by FHA. File a partial claim to FHA. VA is a little trickier. VA allows you to extend the loans. They don't have the same kind of structure with a partial claim, and you can extend the loan, but the interest advances that you've done, you don't recover it until, and so it's kind of just as VA has a no bid program where it doesn't fully cover your losses. So with VA loans, you don't have as many options on the forbearance plan. Now, fortunately, in this day and age, if the forbearance occurs and the markets are still relatively with very low interest rates, you will have an ability to kind of do a rate and term modification with the interest rates being lower, you'll be able to help out the borrower and roll in the balances there on the VA loan. So there are other alternatives that today are reasonable and minimize your losses and your exposure as a servicer. So that, let's go to the next slide. So that there probably are ways to recover all of your risk and your advances. Certainly with Fannie and Freddie and FHA, VA, it's a little bit trickier, but you should be able to be made whole there too, or largely whole. Of course, all of this is after the fact. While during the forbearance period, you're still making those advances. You're still going to be out of pocket, and so the claim process will make you whole, but it'll make you whole a year later, and you don't get any carry costs. So I guess you could argue you're not even being made whole because you've been out of pocket for that year with those interest and principal or tax insurance advances rather. Principal and interest are not a problem with Fannie and Freddie after 90 days, and with Ginnie Mae, you can, if you don't buy the loan out, you can also, they have a P&I advance program. And you also have with Ginnie Mae, of course, when the loans are prepaying, you can use some of those prepays to offset your P&I advances. So in periods of high, like a refi boom like we currently have, the P&I risk is relatively low with the Ginnie Mae. And you do have some backups if you get to that. Let's do next. Okay, so the other strategies that you can pursue is just from a cash standpoint, you have to think, if you haven't sold the servicing to an aggregator because either their bid was very low or non-existent. The good news about MSR is you can capitalize it, but you don't pay taxes on it right away. You pay taxes as you earn revenue from the servicing fee over time. So you get to defer taxes. That helps you a little bit with the cash, and of course you're getting monthly servicing fee. That's why it has value, right? So that's giving you some cash. You can get lines of credit for MSR, and nowadays there are a number of banks who are offering. If you talk to your MSR financing bank, they are offering part or adding a little bit with a line of credit dedicated to T&I and corporate advances. So banks have realized that, and they've stepped up a bit, the ones who lend for MSRs. If you have servicing and you don't have a line of credit with MSRs, I would, you can talk to us about, we can introduce you to some banks. If you don't, my first call would be to your warehouse bank and ask them if they offer a line of credit to MSRs. If they don't, or they have issues with you for one reason or another, then I would suggest talk to us and we can make some introductions, because we know a number of bankers who do lend on MSR and will give credit for advances. So, and I would urge you, if you haven't, and because you've never needed it and you don't want to sit there and you don't want to leverage your MSR asset, it's risky enough as it is. I understand that. Don't use the line of credit to purchase more MSRs. Use it to finance your advances. So I would strongly urge the people on this phone, on this webinar, who do not have a line of credit, that they should explore that sooner rather than later. The last choice is to sell servicing. That's always a good alternative. But as you saw earlier, right now the market for servicing for MSR sales is pretty limited and pretty weak. I imagine as the things stabilize over the course of summer and fall, assuming they do, then there will be a stronger appetite for MSRs, particularly these newly originated loans that, remember, everybody's doing VOEs, I assume, right before closing. So the risk of forbearance on the newly originated stuff that you're keeping is lower than the risk of an existing portfolio. So if you're just starting to create your portfolio, you're creating one with a fairly low forbearance risk and a very low interest rate. And so 6 months to a year from now, that would be a potentially very attractive servicing sale and something you can consider down the road. Next slide. All right, I'm gonna hand it back to David to kind of summarize kind of where we're at with what Bill and I had talked about. David, if you want to take it over.
Yeah, that sounds great. That sounds great. Thank you, Bill, and thank you, Phil, for all that insight. Really do appreciate it. Kind of as we wrap up here and we kind of look at some final thoughts to share with you. Certainly, the current market probability we think is probably very temporary, but really still have to keep an eye on what's going on because as Phil pointed out from his slides earlier, the effects of what's happened to us so far can certainly linger. So, and then changes are happening more quickly than we think. Certainly, the market over the last 90 days has shown us that. And it's certainly starting to occur more even on the MSR value side. So that's certainly something to take a look at and keep an eye on. And even as the markets improve, and aggregators get better, you're still looking at some significant opportunity to retain that you probably haven't seen in quite some time. So certainly this is an area that we can help you. Phil described one of our models that really goes into great lengths to help you select the very best loan to retain versus release. So, and then obviously with retaining comes more responsibility. You have to certainly be wary of cash and advances. And certainly cash management, which is very important. We've got, Phil's built some really extensive models that really help you forecast cash flow needs almost down to the penny. So it's certainly something you have to do more often than you've done in the past and continue to take a look at. And then as far as opportunities for timely sales, certainly we are watching more buyers show interest in the market. Certainly the market's not at a place where, selling is a good opportunity, as we've discussed several times, but it's clear that there's a heavy degree of interest as values ultimately will start to return, hopefully through the course of the year. So, and then, and certainly reach out to folks like ourselves or your MSR advisors to help you through this strategy. It's not something you should do alone. Certainly something we can help you with and prepared to really help you be able to make good decisions moving forward. So again, thank you for your time. Thank you for your attendance. There will be a copy of this going out to all those who signed up for attendance. And no questions at the moment, but if you have anything that you would like to send in, please feel free to respond through the question or the chat box, and we'll be happy to get back to you and respond. Thank you again for attending, and we look forward to engaging with you soon. Thank you.